So good morning again, and welcome to this session on investing in Chinese equities. The Chinese stock market, as everybody knows, has a number of unique attributes. I thought it might be interesting just to frame the discussion to outline some of those. First is, of course, that it's a fairly unique institution. It's only been around since the 1990s, fairly recent. Second is that it's dominated by retail investors, which account for about 80% of the turnover in the market. The third is that it's one of the highest turnover markets in the world. Of course, there's large government ownership, both in state-owned companies that have been partially privatized, but also through official intervention to stabilize the market. The fifth is that there are multiple share classes, A shares, H shares, N shares, P shares, S shares, so on. The sixth is, of course, which is really important, a closed capital account and limited access. And the seventh is that it's one of the most volatile markets in the world, annualized standard deviation of about 30%. And of course, there's frequent government policy intervention. So Debbie mentioned that she thought it was a good place to spend a risk budget and a place that was where the market was not fully efficient. And obviously, there are a lot of opportunities, but there are a lot of risks. So I'm really pleased that we have two very experienced practitioners to help us understand the market a little bit better. Courtney Wei is with China AMC Management based in Hong Kong. She worked for Battery March for a number of years here in Boston, where she managed emerging market equities. And she also worked for the Chinese government for SAFE. So she was responsible for the custodianship of official assets. And Bin Shi is with Acadian Asset Management. He has a background in quantitative disciplines and quantitative finance, and he's going to talk a little bit about quant techniques in China. So welcome to you both, and Courtney, very interested to hear what you have to say. Welcome.
Thanks, everyone. Thanks, everyone, for coming today, and thanks for CFA institution for providing these opportunities for us to share our thoughts on China, investing in Chinese equities. And thanks, George, for inviting me. I still remember George from 10, 12 years ago. He gave a speech on why he thinks China will appreciate its currency and how different a world it is today. So thanks, George, for inviting me today. I have, George actually gave me a list of topics to choose from. All are very difficult. And I looked through them all because investing in China, there is a lot to talk about, the economics, the policies, corporate governance, the debt, currency, et cetera, et cetera. But today I want to talk about something a little bit different, even though we may have already talked about for the last couple of years, but I think the market has not fully appreciated it. So I don't know how to move the slides. I have prepared the slides. Is it on? I'm sorry, I just want to make sure we have the slides on. While we are getting there, I probably can just talk about a few things. Chinese market is one of the. Is it on? Mm-hmm. Okay. The Chinese market is this is the wrong slides. Okay. This is the wrong slide. Yeah, never mind. There are a few slides. The slides is on the back. Yeah, here. even though this is not what I intended to show, but we have, I want to, these slides will do the work. Today I want to share with you about the Stock Connect program. China A-share is already the second largest market, the equity market in the world, and Hong Kong, China is the fourth largest market in the world. With this program, Stock Connect program, we will be able to connect those two major equity markets together, and that covers a majority of the market cap on both sides. As you can see on these slides, on the left side, this provided a good buying opportunities for the mainland Chinese. In the past, as you know, because of capital controls, mainland Chinese were not able to participate in the Hong Kong market. And ever since the introduction of the Stock Connect program 2 years ago, the light blue line on the left side of the page shows that the net buying has been kind of one way, nonstop, going up. And accumulated to today, it's $57 billion of net buying. And so that tells us that we have a new buyer on the market who buys every day, day in and day out. We have been monitoring the buying pattern, and on some of the lighter days, we are seeing 1 to 2 billion RMB of buying on daily basis. On some of the heavy days, $3 to $5 billion of buying. And that's partly explained why the Hong Kong market has been on an upward trend ever since the beginning of the year. The market just refused to correct because there was very strong buying into the market. The next page, we look at the buying. We look at the absolute amount of buying into the market on the previous slides. Here we are trying to gauge how big are they compared to the whole market. It started from like 0.5% of the market turnover in Hong Kong at the beginning of the Stock Connect program, and today it stands at 5%. So if at the beginning it was marginal, and today it's definitely meaningful, a meaningful player in the market. And we did a little bit study and then trying to estimate where can we go into the future. This is a comparison of Hong Kong as a percentage of China as a percentage of Hong Kong. You can see in terms of tourist arrival in Hong Kong, it's a major number, or in terms of IPO in the Hong Kong market, it's more than 90%. As a Chinese companies, market cap as a percentage of Hong Kong market cap, it stands at 65%. And today, the southbound trading volume as a percentage of the total turnover stands at 5%. I won't be surprised that this number go much higher in the next 12 to 24 months to something like 10-20%. And given that Chinese companies are the major part of the Hong Kong market, 65%, so if this number over time goes to something like 50% or even higher, I think that's something reasonable to expect. And what does that mean to the market? On top of what we talked about, we have a new buyer who buys every day. We think what's more important is the structure change over time. The Hong Kong market, as we know it, is what we call an orphanage market, meaning that even though the market, the companies traded there are Chinese, but Chinese investors were historically not allowed to invest there. So they are, in a way, at the mercy of global investors. When things are going well in US or UK or Europe, investors like yourself probably will feel like, oh, we should buy some growth names, buy some beta, we go to Hong Kong. But when things are not doing so well, and when we feel risk reverse, and then what likely to happen is that people sell Hong Kong, sell beta, sell Hong Kong, and that introduces volatilities unnecessarily to the market. Going into the future, this may change. Right now, more than 80% of Hong Kong market is owned by global institutional investors, and they don't necessarily have the confidence when things are not doing well. They probably want to sell. Versus in the future, if we have more of local investors, the southbound flow become a much more meaningful player in the market, then they are the ones who deal with the companies on a daily basis. They work for them, they use their service, they know them, they know somebody who works for them, etc. So they will be having more confidence when things are not looking good to buy into the market. So over time, we should see volatilities reduced and valuation being enhanced. China AMC, as George kind of alluded to, we are the largest mutual fund in China, and in our Hong Kong subsidiary is a pioneer in investing in Hong Kong, China. So we are uniquely positioned in kind of pitching this business. My colleague actually is in the room. He's on the sales and marketing team. He talks to those institutions who are interested in investing in Hong Kong through this program from mainland China. So we talk to banks, we talk to insurance companies, pension funds, et cetera, The feedback we have been receiving is that they are very interested, for two reasons. One is hedging potentially the currency depreciation pressure. Number two is that valuations are very attractive versus what we can get in mainland China. This is a comparison of valuations of Hong Kong, China compared against other against its own history, and then we have another slides looking at Hong Kong valuations against other major indices. So no matter how you look at it, it looks very reasonable. There are, there are two reasons why mainland Chinese investors should be interested in that. Because as you can see on these slides, mainland China's valuation is probably one of the most expensive compared to the other exchanges. One of the reasons is because of the capital controls. Wealth accumulated over the last 2-3 decades have nowhere to go but to invest in expensive properties, expensive equities, or expensive fixed income assets. Now, this is the first time China opened up a channel that people, institutions and households alike can invest in Hong Kong market. That explains, the structure change in Hong Kong market probably will push up the valuations of Hong Kong, and the outlet by the Stock Connect program probably can let go some of those bubbles if there is a bubble, let go some of the air in the bubbles in the assets within China. So that's pretty much I would like to share about the Stock Connect program. In short, we think this over time will bring some structure changes to the market, and that will provide some very good, interesting long-term investment opportunities in China.
Thank you.
Okay, thanks.
So Ben is going to say a few words about quantitative investing in China.
Right, so maybe I can go there.
Sure.
To talk. So first, good morning, everybody. And thanks to George and thanks to CFA Boston Society for organizing this great event. It's wonderful, I think. Especially, I like the title of this event, China from Inside and Outside. I grew up in China, so I still have a lot of friends in China. Quite a few of them actually works in the investment management industry and the related government agencies. So from that perspective, I'm an insider, but I came to US since 2001 and worked for Acadian for about 12 years. So I constantly researched China from a foreign investor perspective. So in this perspective, I'm a outsider. So China from inside and outside. That's fit my perspectives. It's great. So it's an honor to be here. I'm very happy to share some of my experience of investing in China, in Chinese equities, especially using a quantitative approach. First, I would like to talk about why quant approach should work in China. So in the media, Bloomberg, New York Times, they often cited the Chinese stock market as a casino place, which I don't disagree from Chinese investors' perspective. It's indeed a casino place for most Chinese investors. It is illegal to gamble in China, but it's legal to play stock market in China. So gambling was an inherent culture of Chinese culture, or more broadly Asian culture. There was a behavioral experiment, a famous behavior experiment by a US professor at Berkeley. They conducted an experiment of the correlation between the lottery tickets and the Taiwan Stock Exchange. So when Taiwan Stock Exchange is closed, the lottery ticket sales volume is shooting up. So that tells you that gambling is important in this culture, especially if you allow the retail investor to play in the market. So there are a lot of irrational behavior. There are many behavioral biases is going to happen in the market. From active portfolio management perspective, this is the source of alpha. This is going to create a lot of mispricing opportunities in the market. So just give you some statistics. George just mentioned that 80 to 90% of the market volume actually is driven by retail investors. And more important is that the investment industry over there is still very young. I think Sarah just mentioned earlier in the previous session that the average number of years of experience for the fund manager is 5 years. But if I have older statistics. So this is as of 2012. It was reported that the average number of years of experience for the fund managers in the Chinese domestic investment industry is 2.5 years. And a quarter of them actually have less than 1 year experience, and they're managing your portfolio. So those are the Chinese investment industry. They're very young. They're still at the very developing stage. So in combination, the large body of the retail investor and the inexperience of investment professionals, they inevitably is going to create a lot of mispricing opportunity in the market, and that's why the active manager should work. If you are a quantitative investor, if you can use a systematic process to research and study the market and put a quantitative process in the investment, you should generate a lot of alpha from there. So this is also consistent with Debbie's argument that there are rich alpha opportunities in China market. So that's my first point. The market is inefficient in China, so that a quantitative process, a systematic, disciplined quantitative process should profit from this rich alpha opportunity. The second is that the market has grown quite a bit. There are about 3,000 stocks traded on the Shanghai and the Shenzhen Stock Exchange. So this large number of names is to allow the quantitative process to work. If you only have a very small pool of numbers, the quant process usually doesn't work that well. But in China, they have 3,000 names that you can play with. So it's very good for quant. And more than that, the Chinese market has its unique characteristics. It's less concentrated in size and sectors comparing to the other markets like US or Hong Kong. So if you think about the Hong Kong stock market, 90% of the names or market values actually are financials, industrials, and energies. While the percentage in the Chinese market is about 50%, 50 to 60%. From that perspective, the size is more evenly distributed in the local domestic market. And also, if you think about size, if you rank the stocks by size, the top decile of the market value in the Chinese market account only about 50 to 60% of the market cap, while in Hong Kong or in the US market, that percentage is about 70%. So they are more evenly distributed in size and sectors. That's also very important for a quant process to work. There are also enough daily volume to allow you to active trade on the market. So the daily volume is about the same as the US market, while the market cap is only about a quarter of the US. So it's a very active market. So that's my second point. The universe is big enough for a quant process to work. My third point is that actually, if you are already a quantitative managers in the global or emerging marketplaces, you probably have the data coverage for the Chinese Asia already. I think Watscope, Abyss, they all carry data for China Asias. But if you want to do better and you have more flexibility in your budget, you can also purchase more specialized data from Chinese vendor called Wind and some others. So those platforms are easily accessible. So if you are a experienced quant, you should be able to put a process to work in a fairly short amount of time. So that's why I think quant process should work. There's 3 points. One is that the market is inefficient, so the active management should be able to put up a quantitative process to profit from the mispricing. Second is that the universe is big. You can make the statistical process work. The third is that there are enough data, there are enough informations that you can compete with the local fundamental investors. So that's why quant process should work in China. So with this, I want to touch a little bit about the risk of investing in China. So there are a few of them. One of the biggest one is the capital control. If you are a foreign investor and if you have liquidity concerns, you probably want to think about it and plan ahead about your liquidities, because there may be a risk of repatriation of your fund. That's something you need to work out. The second is that you need to have some local knowledge, local institutional knowledge to understand your model, to interpret your model efficacy. China is a developing country, and their capital markets is constantly evolving. For example, there was a major accounting reforms around 2007, 2008. So if you put some fundamental data into your model, and you are not aware about this accounting change between 2007, 2008, results maybe can be interpreted in a different way. There is also a constant change of the IPO reforms. So those are the things will affect some of the market anomalies over there. So you need to have some local institutional knowledge to develop an adequate model. The third point is somewhat related to what Courtney said. The valuation in the Chinese stock market is still very high, but the high valuation or expensive part is mostly in the small and middle cap spaces. So if you can carefully adjust your style tilts, you probably can hedge yourself to some extent. The last point is that Chinese Asia is still not part of the emerging market benchmark, the MSCI EM benchmark yet. So if you are a relative return investor, if you're concerned about the tracking errors, this is something you need to be aware about. So those are the risks about China investing. So with this, I will conclude my introduction and turn over to George.
Great. Thank you very much. It's really very clear. And I'm very interested to learn about the average experience level of portfolio managers in the market. Yes. Let me start with a pretty basic question for both of you. What, in your judgment and your experience, drives, do you think, the systematic return of the markets in China? We talk about earnings and discount rates, cash flows and discounting them back, but China seems to have some other different characteristics. So what are the drivers in your view?
Okay, I can start. So when we talk about China, we're really talking about two markets. As I was trying to mention, the second largest market, which is China-Asia market, and the fourth largest market, which is Hong Kong, China. So Chinese companies listed in Hong Kong or U.S., the MSCI China, we're well aware of. So when we talk about those two markets, they have different drivers, obviously. I personally am more kind of on the MSCI China, Hong Kong China part. So I probably can speak more about this market. I would say in this market, because it's dominated by global investors, the earnings, the cash flows, the fundamentals are more of a driver than anything else. So if a company that could not perform, they can probably tell a good story for a little bit, but at the end of the day, if they don't deliver, then we will have the short sellers coming to the market and trying to short their names. And recently, we have a few examples of that in Hong Kong, and then those names were heard. So I think that's a major difference between Hong Kong, China, and China-Asia, where in China-Asia, you cannot short the market, and especially after the stock market crisis in 2015, government regulators have become very protective of the market. So as you can see, the movement of the market managed to a very small range. I actually prepared a few slides because George asked me to talk about Asia, even though I'm not an expert of Asia market, but I did borrow a few slides from my colleagues. And ever since the crisis, the stock market crash in 2015, there are some changes in the market. One of them is a national team, what we call the national team. That's 22 accounts spread across different organizations, including SAFE, including some of the major asset managers like ourselves. China AMC manages a portion of money for the government to stabilize the market. So that accounts for 3.75 trillion RMB of market cap, or more than 6% of total market cap. And that's another force in the market that kind of changed the dynamics of the market. So the movements, in the past, you can kind of the small caps, especially the ones who has very good stories, growth potentials, tend to command very high valuations. But things are slowly changing in China, especially in the last kind of few months. We are seeing what we call the Nifty 50, the large caps of the index, are doing very well because the national team are more present in those names, while the rest of the market were not doing very well because the national teams were less of a presence in that space. So I would say, going back to George's question, in Hong Kong, China space, it's more fundamental driven, and that shows in the valuations much more reasonable, and it shows in the kind of individual names behaviors, because shorting individual names are allowed, and then we do have a lot of institutions trying to take advantage of that mechanism. While in Asia, it is less clear. In the past, growth in names are kind of rewarded by the market. But going forward, because of the changes introduced after the stock market crash, that there are new dynamics in the market.
Thank you. How about on the A share side?
So I'm a quant, so I will speak from a quantitative perspective. How do we interpret or understand the return from the Chinese A-share market from a behavioral perspective? So what drives the returns of the market? So there are a few things. One is that the valuation. So one of the important characteristics in the Chinese investor community is that investors, those retail investors, they love the growth stocks. They just don't like the value stocks. They just overbid the growth prices. But as we all know, this is a classic example of behavioral finance mistakes that all the institution managers trying to avoid. But the retail investors, they take the other side, they bid up the growth prices. So the valuation factor works very well in China, and just because of this group of inexperienced investors. Valuation, it's important. Second is that if you think about growth is still a very important driver for the short-term returns in the relative short time period. So for example, the growth, you can think about it from two perspectives. One is the growth, one is the historic growth, and the other is the expected growth. So the historic growth, if you look at the company's fundamental earning growth, they still have good values in our quant space because investors, they don't really look at the earnings in A-shares. They don't know about it. Most of the retail investors don't know how to interpret the earnings. There are different definitions of earnings. They don't know how to interpret. But this fundamental earnings growth eventually is going to transfer to the company value. It's going to increase the company value. So the underreaction to this earning growth is going to create opportunities for the quant investors. And there is also a mistrust to the brokerage industry. So when the brokerage push up recommendations, most investors just don't really believe in their recommendations. So the recommendation change or earnings estimate changes, still investors also tend to underreact. So the expected change of growth is also an important source of the returns. So those are a few important behavioral phenomena that we observed in the Chinese market.
Interesting. You have kind of a segmented market, but it's a little bit integrated. I wanted to ask you about the A-H share premium, right? Because that bounces around. I'm sure there have been many academic papers on that, but how should investors think about that? Is there some arbitrage opportunity available? And I guess over time it's going to go away as capital controls are ultimately lifted.
So it talks about the valuation gap between A and H. When we talk about A, it's, A share is actually, within A share, there are two segments, the large caps, what we call Nifty 50, and at the same time, the rest of the 3,000 stocks, that's more of the small cap. So those two different segments, their valuation gap against the counterparties in H share are very different. The small cap, as Bing was talking about, growth in names and names with very interesting stories, they tend to trade at very high valuations. I think Shenzhen Index valuation in terms of PE is still at 39 times. That's after adjustment of many months. And while the valuations of the large cap, usually dominated by the banks and other financials, their valuations, I don't have the numbers on top of my head, but they are much more reasonable, kind of more kind of converged with the H share valuations of the same sectors. And so we are really talking about two different segments. Within why we think Stock Connect program is interesting is because, for the same kind of stuff, especially in the growthy area, the small cap area, you can get the same thing at much cheaper valuations. The same type of names in Hong Kong will be trading at single-digit multiples or maybe low double-digit multiples, while in Shenzhen, it's easy to see names trading at 30 to 50 times. So over time, we think this valuation gap should converge. Maybe it won't disappear totally, because at the end of the day, those are two different markets, and currencies, accountings, tax, all those things are very different. So valuation gap probably won't disappear, but we definitely think they will narrow. On the large cap side, again, they kind of converged. In some cases, like the banks, arbitrage opportunities already kind of disappeared in terms of valuations as well as dividends. And how can we, what kind of opportunities are there today? We definitely kind of look at the changes in the market and emphasize more on the kind of arbitrage opportunities today than in the past. In the past, we always know there is large kind of valuation gap, but that gap probably will be there for the long term, so we don't necessarily treat it as a kind of a factor of returns. But going into the future, we think with the introduction of Stock Connect program, this could change. One of the example is one name in the materials sector that the A share is trading at 2 times of the price of H share. What is more important is that the company management is looking to expand. They're looking to raise capital, and naturally they will be looking to raise capital in the A share market. So the money they raise will be at a valuation discount to the trading price in A share, but at a large premium to the H share price. So what does that mean is that the moment they finish fundraising, we as H share investors will get our book value enhanced, because that's at a major, large premium to the H share trading price. And that's the way the management is helping us to kind of arbitrage this opportunity. We think more of this will happen, and as a matter of fact, there are another company trying to do the same thing. So through the kind of arbitrage activities of the investors, kind of trading in both sides, as well as some of the opportunities created by the management, we think this over time valuation gap will narrow.
Interesting. Yeah. And Ben, of the 3,000 A shares that you mentioned, how many do you think are truly investable? Are there issues in terms of liquidity? And related to that, how many earnings estimates? Do all 3,000 have earnings estimates? Are they all covered? What is the state of play in terms of the sell side, in terms of coverage of names?
Yeah, so among these 3,000 names, I would say that it depends on you on the capacity of the strategy, right? So most of them are still active trading, but occasionally they will have names that get suspended for so that will leverage down you to between 2,000 to 2,500 names that can be investable. They have enough liquidities. So the liquidity is comparable to the U.S. small cap range. So if you think about it, so from that perspective, it's probably more understandable. So in terms of earning estimates, so not everyone has earning estimates, but almost half of them have it. So
half of them.
Yeah.
Half of them. Yeah. Right. Maybe we should throw it open for questions now. If any questions from the floor? Jin, why don't we start with you? Okay, go ahead, please.
Okay, so I have a microphone. So the question is to Bing. I like your comment about the reasons and risk about quantitative approach investment in China. Agree most of them. I also realized that data quality was a concern a couple years ago. In the reason 3, you mentioned that the data coverage is good. My question is more about the data quality. So many years ago, when people think about quant investment in China, one of the concerns is about a lot of firms manipulate the accounting data. I'm not sure how the situation evolves, and is that still a concern? Thank you.
Well, so data quality issue is not unique to China. I would say that all the EM countries have similar issues for the data qualities. China actually, relatively in terms of the disclosure, the accounting information disclosure, they actually have a very strict enforcement on this since the reform after 2008. So obviously the accounting information is by itself it is good. It is what it is. The management may have manipulated earnings to some extent. That's we all learn. For example, in the U.S., if you plot the distribution of the earnings in the U.S., it's probably more like a normally distributed. You have equally number of positive earnings and equal number of negative earnings. So the average is about around 0. But if you plot Chinese earnings, there's a sharp cutoff at the zeros. Many firms, they just manipulate their earnings so that they will not have a loss. Because there's a special regulation in China. If you keep losing for 2 years, you're going to have a special title called ST, special treatment. And after 3 years of losing money, you should quit. You should exit from the market. So those companies, the management tried very hard to make sure they don't lose money, but the technique they're using sometimes is very naive. So from this perspective, they're managing their earnings, but those earning management techniques is very easy to detect.
Interesting.
Yeah, there are a number of Chinese ADRs where the controlling shareholders have made offers to delist and then with an ultimate goal of relisting on the mainland, either through a backdoor listing or an IPO. But the process for many of these deals is strung out. What do you see going on from a regulatory standpoint, and are these kinds of transactions actually pretty much dead?
You have some thoughts on that, Courtney?
Yeah, I think this type of transaction was pretty popular last year or the years before. And going forward, we think it's probably going to be harder to execute. The reason is because of the capital controls. RMB was under heavy kind of pressure last year, and capital control really tightened up. So to do the delisting and then relisting in Asia, that needs a lot of US dollars to buy shares back, and then take the assets to Asia and get listed and hopefully get a higher valuation. Because of the capital control, it's so much harder to get US dollars, and it doesn't make that much sense to continue to do that type of transaction anymore. And plus, because of the IPO reforms, A-share in the past command a much higher kind of premium in terms of valuation, but at the same time, you got to wait a few years before you get listed. So that process has a lot of uncertainties. We think, a lot of them probably doesn't make sense to continue to do this. I cannot say nobody will continue to do this, but we think the number of transactions probably will be reduced dramatically.
So I can share a story of one of my college friends. He had a kind of private firms in Shanghai specialized in education. So 3 years ago, I think they had a plan to IPO in the US. and then they saw that the Chinese market valuation is much higher than the US. So you all know that they have these VIE structures. So they removed that VIE structure and prepared to IPO in the Asia market. And then Asia had this a series of the chaotic situation in 2015 and 2016. And also since 2016, the IPO process has been dramatically different. So the Chinese regulator has opened the IPO much faster than before, so the valuation was not as high as before. So this company actually decided to redo their VIE structure to prepare for the IPO in the US. So that's just an anecdotal observation about this trend. So.
Interesting.
Insider trading is China's markets play with insider trading. I'm just wondering whether that affects your decision-making in investment. Thank you.
I'm sorry.
The question was about insider trading and how that impacts the market.
Well, historically, that's a big issue for Chinese market. Inside trading was a big force in the market, and the regulator has taken actions against those inside trading. At least in the last year, we saw some very big examples of inside trading. So maybe you are aware about the number one hedge fund in China. The boss was arrested and just because of the inside trading. And the punishment was very severe by the historical stand. So from that perspective, if you believe that the government is to continue this enforcement, the inside trading will be less a concern going forward.
Have you experienced like pre-announcement drift in the Hong Kong market? Do you think sometimes stocks rally just before announcement?
There are cases stocks moves, and later there was some kind of announcement, but we cannot pinpoint somebody. There is suspect that somebody knows something ahead of time, but it's hard for us to say it is insider trading driven or not. But overall, my feeling is that in China you need to understand the drivers of the major shareholder, the controlling, the chairman of the company. That's the basic homework we have to do as the fundamental investors. So we actually spend a lot of time on that, understanding the corporate governance of the companies we try to invest. We need to understand, are they motivated to make money through their main business, and hopefully share price will reflect that, or they're motivated to make money from investors by manipulating the share price, and then by selling shares high to us, and then that's their major way of making money. So that's some of the things we try to understand as fundamental investors in China, and we think. To me, I think investing is always very difficult, no matter where we are investing, in the developed markets or emerging markets. In developed markets, for example, if you want to invest in GE, you need to become an expert of a dozen industries, so it's not easy to do. But investing in emerging markets like China, then the homework is more on the corporate governance. You need to understand the motivations of the major shareholders. Are the senior management motivated to work for you, or something else? So I think that's maybe not directly to your question, but I think that's key to understand, and that's why we are sitting in Hong Kong talking to companies, multiple times a year, trying to track their progress. And we feel like if every time they come to us, tell us the same story, we feel like maybe they're doing the right thing. If every time they come to us, they tell us a different story, or maybe every time they come to us, the next day they're doing a placement, then we will be concerned. So that's what we're trying to do to address the issues around corporate governance.
So related to your question, there was a law just published a week ago regulating the insider, so including management and the investors, the major stakeholders, the period of liquidated shares. There was a much stricter standard than before, so that will, to some extent, at least show the stance of the regulator who wants to go against the inside tradings.
Other questions? Jen. Okay.
Hi, I have a question about the Hong Kong market. I remember a couple of years ago, the Hong Kong mainland Stock Connect has a quota, and to what extent the quota has been used up, and why is the Hong Kong market valuation is so attractive, given the fact that the Stock Connect program has been playing an increasing role in the market? What happens? Why is the forecast of future earnings for Hong Kong companies so low? How do you explain the PE ratio is so low compared with other international markets?
Okay. This is about the Stock Connect program. So the first question is about quota. Initially, when it was first introduced 2 years ago, we do have a total quota control of 250 billion RMB. That's as much as you can buy. And that's why you can see in the charts early on, we saw kind of a slower growth last year in terms of net buying into Hong Kong. But the government took out the cap. Now, Chinese investors, household or institutions, can buy as much Hong Kong shares as they want. So that's a major change. And you saw from the chart that the speed of buying into Hong Kong really speed up over the last few months. So that's the question number one. And then the number two, related to the valuations of Hong Kong shares. Again, I think the reason is because majority of the investors in Hong Kong are global institutional investors, and Hong Kong to them is a peripheral market. So they don't have to be in Hong Kong, and when there are issues at home, they pour money out of Hong Kong and put it back to their home market, and so volatilities in Hong Kong is high, and that depresses valuations. And with the introduction of the program, ideally we should see the valuation gap narrow quickly, but we are still seeing pretty large gap. The reason is because we are going, a lot of institutions we talk to, China AMC talk to a lot of them, they are in the progress of analyzing the markets. They need to understand, because this is the first time, after all, they are allowed to invest in Hong Kong in a major way, and in the owning as an owning legal way. So in the past, because there was total quota control, there is only as much as there is not much they can invest. But now the gap is lifted; they can invest a lot more, and they are doing a lot of study on the legal framework, on the regulations, and they are and then choosing the right managers to invest through. So I would say probably a lot of them, as you can see from the numbers, 57 billion already coming in Hong Kong, but I would say we are less than halfway through. We did a study of how much assets can be allocated to Hong Kong. So between the 60 trillion of savings and the balance sheet of insurance companies, the wealth management products, the mutual fund in China, we estimate 100 trillion of those assets, a small portion of that, maybe 1%, can be diversified into Hong Kong. That's a large number that's probably still on its way, in terms of asset allocation, still on its way coming to Hong Kong. And going into the future, if that wealth continues to grow at 5% every year, and that growth of 5%, some of it, maybe a growing portion of that money, will need to invest in Hong Kong. So over time, we should see more money coming into Hong Kong, and eventually, through that action, the valuation gap will narrow further from here.
Do we have time for one more question? No. Okay.
Thank you.
Okay, all right. Thank you very much. Thank you very much. Very instructive. Our next panel is actually on Chinese tech stocks, which is the next Alibaba. So it's moderated by Zoe Kelperwaite of Harvard Management. And again, thank you to our panelists.